Hello everybody, welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As always, keep in mind that there's risk involved with any trades that you take. So you want to manage risk in a way that makes sense to you. And we'll go through some ideas on how to do that within our order window in any trades that we simulate. There are some built-in features within our web trader and the AvaTrade app that make the risk management side of things quite a bit easier as you're setting up your trades. And also keep in mind that what we go over is not meant to be financial advisement, but is coming from an educational perspective. Now, from our main website, we can log into our web trader, which allows you to trade on both MT4 and MT5 accounts from one location. And all the features that you see in our web trader are also available in our app. That would include the free signals, the market news, the market buzz, economic calendar, etc. So lots of tools there for you to make use of. Now we'll focus more on the fundamental analysis tools today, but there's also technical analysis help that we'll take a look at maybe within some of the trend analyses or signals as well. So if you click log in here and enter your email address and password, then you'll be in our web trader platform. Few things to talk about. Even before looking at economic announcements, one would be the U.S. election and its effects on the markets and future expectations of how the economy may go and economic policy within the U.S. and the greater effect that it can have obviously on global markets as well. With the U.S. being the largest economy in the world. Donald Trump obviously has won the election. We did a pre-election webinar last week talking about the different views and platforms that the candidates had. And the Trump side of things is, in terms of economic effect, is expected to have been exactly what happened there with the markets. The instant reaction was joy on the stock markets around the world. The major indices had pretty big gains. Some stocks in particular had sharp climbs. And the reasoning behind that is the Trump platform and what he plans to enact is to do away with a lot of the increased regulations that the last administration put on, continue with further tax cuts on corporations and businesses. He already had lowered in his first term the corporate tax rate down from up around 30 to down to 21%. And he promises to push through, if he can get it all passed, a further cut in the corporate tax rate down below 20%, something like 18%. So there's a lot of positive reaction on Wall Street and the markets because of that type of stance moving forward to cut regulations, especially in the energy industry, to do a lot of deregulation, to open up drilling, to open up fracking in the US in particular, and to try and get the taxes down on these corporations even further. So with that as the backdrop, we saw, I think the Dow Jones went up over 1,300 points, tremendous climb, and as well as the other major indices. And we also saw maybe a slight weakening of the US dollar against a number of different pairings. And that's normal in an environment where fear is low that the USD might weaken a bit and other currencies could have some gains against it. Now, moving on from that backdrop, we also have today a rate decision, both in the UK and in the US, and both of them are expected to lower interest rates by 0.25%. Now, the US was expected to lower somewhere by 0.25% to 0.5%, depending on who you asked last time, and they chose the larger rate cut in the US and lowered by 0.5%. So that could happen again today if the FOMC committee and Jerome Powell decide to be a bit more aggressive The expectation is 0.25%. So, you know, if it comes in at 0.5% again, we could see a large reaction on the markets. If it comes in as expected as 0.25%, probably a more muted reaction, but probably still some reaction. Lower interest rates tend to weaken currencies in general. A lot of that could be cooked in. The USD has weakened leading up to the announcement today, the rate decision. But if they decide that, hey, inflation is still too high, and you know, the jobs numbers were horrible out of the US last week. Anyone who watched the non-farm payroll numbers come in, we could take a peek at those numbers. Boy, were they bad. Private sector actually lost jobs overall. Manufacturing lost thousands, tens of thousands of jobs in the US overall. And the only reason there was even 12,000 gain in jobs was because of government hiring, which doesn't show economic growth at all. And so, as bad as it could be, those numbers were last Friday out of the US on jobs. So that could play into the decisions now of what does the FOMC committee do, and maybe they push for another larger cut of 0.5% instead of 0.25%, but we just don't know for sure. And you know, it's possible that if 0.25% comes in or less, if they keep it flat for some reason, you could see maybe a rapid strengthening of the US dollar in response to being disappointed that there's not a larger rate cut than that. But we'll have to keep our eyes on it and see, but you need to be aware that those announcements are coming later today. And now a third big story, as if it's not complicated enough with the elections and rate decisions coming out of the UK and the US, and some other big announcements. We also have the Middle East war situation, with now that the US elections are over, with maybe an increased likelihood of some sort of larger escalation between Israel and Iran. And so if you're looking to trade on something like crude oil, you have to be aware on the risk management side of things that any huge escalation in the Middle East in general, that could have fears of supply disruption and cause crude oil prices to spike upward. And we've seen that type of effect in the past when there were increasing fears of some imminent situation with the war in the Middle East. So some things to keep an eye on bigger picture wise. Now, if we want to focus on more short-term fundamental news, we can go to the economic calendar. And so let's do that. And so the economic calendar allows us to know exactly when certain announcements are coming and what the past movements have been surrounding those announcements based on how they came in. Now, a number of announcements already came in today. All I did was choose today's date. I've got only high and medium level importance selected. I left off the low level announcements. They have less effect typically on the currency pairing movements. And I chose the countries I'm most interested in here. Now, as I scroll down, we'll get to the numbers that have not come in yet. That's this column here. These are the current day's numbers. These already came in. This column here is the expected numbers. And this column here is what happened last time. So out of Great Britain, it's expected, like I mentioned, a decrease of 0.25% from 5% to 4.75% on the interest rate. Now we can take a look and see what was the effect of this in the past. And a lot of times these rate decisions, like I said, the movements already occurred leading up to the announcements because everyone expects the announcement to come at the expected rate that they show. So it's expected to drop 0.25%. Many assume that that's what it will be. And so any weakening effect maybe on the pound or strengthening effect on other currencies, maybe that already occurred before the announcement comes, but we can check that. So these are the past announcements. This is the direction they've gone. You can see it's pretty much 50-50. Half the time up, half the time down. Similar distances up and down. And lately, smaller and smaller effect, regardless of which way it went. Okay. If we want to qualify this and say, what if it came in higher than expected? Instead of going down 0.25%. What if they kept it the same? So if we click on that, it has not happened. We don't have any data on that because it hasn't happened in the recent history. What if it comes in below forecast? Instead of a 0.25% cut, it comes in at a 0.5% cut. Again, no data on that. Okay, it came in at expectation each time. So all we can do is look at when it matched the forecast, what happened. And what happened was it went up half the time and down half the time. Okay, as close to half as you can get, 4 and 3. So this data doesn't excite me to want to trade on that. It just seems like you might as well flip a coin as to which way to trade, regardless of how this comes in. Or I should say, if this comes in at expectation. If it comes in above or below expectation, then you probably will have a more defining effect. If they kept the rates the same, probably the pound would strengthen. If they lower the interest rate further than expected, 0.5% instead of 1/4, you probably would see the pound weaken against the USD, and probably in a rapid fashion, because that would be an unexpected situation. Okay, so that's what I'd be looking for with this announcement. Not so much to trade off this data because it's not convincing to me, one direction or the other. If it comes in at expectation, I would be looking at if it comes in higher or lower than expected to maybe make my move if I can get an entry point I like. Okay, so sometimes the data analysis that you look at doesn't convince you that you want to trade on something. Sometimes it convinces you that maybe you're not interested in trading on something, and that's okay as well. And a lot of times that, like I said, that's what the rate decisions end up looking like. We've got jobless claims coming out in the US, initial jobless claims. If this comes in above forecast, makes sense. Bad news out of the US might make it a bit of fear with the jobs markets in general. Already being poor from last Friday. So initial jobless claims, a lot of times the fear response is a USD strengthening. And so if jobless claims come in above forecast, it looks like the USD tends to strengthen. Not in a huge way. After 4 hours, barely 40 pips movement. Okay, not even. 35.9, almost 36 pips movement after 4 hours time. So it seems like not a big effect if this comes in above forecast. Below forecast, larger effect. Okay, I see a larger pip movement, almost 43, not 36. We see 56% of the time down, and the downward movement seems to be bigger than the upward movement. So with 2 of these upward ones barely moving up. So really only 2 of them went up, and the others all went down pretty strong, with 2 staying flat. So I see more of an advantage here if this comes in below forecast to sell on the euro against the USD. Okay, you can speculate as to why. If this is good news, initial jobless claims being lower than expected is good news. It means less people losing jobs, and so the USD strengthened. That kind of makes sense, right? Good news, the currency strengthens more than if there was bad news. So regardless of how you try to justify it in your mind, if you're trading on the data, you can just respond appropriately based on the past data and say, hey, the majority of the time it dropped more often and further down Euro USD with the USD strengthening if this comes in below forecast. And so this is one I would be looking more to trade on if it came in below forecast, because the above forecast has less data points and less average distance down, less movement. Okay, so I'm looking for a larger set of data points and a convincing size movement and percentage, and it looks like under the one circumstance there, you had that with the initial jobless claims. So if they come in that manner, I'd probably be looking to sell in the Euro USD if I got an entry point I liked. It looks like the statistics are in your favor from the past. Okay, and so you can selectively go through even over the weekend for the upcoming week, each of the maybe high level announcements, and find which ones give you the most predictability, and go with those during the week. Okay, and here's the US rate decision. Usually what we see is a large number of pip movement, but not a lot of predictability with this type of announcement. Again, if it comes in above forecast, it hasn't in the history recently, but if it did, meaning if they didn't lower the interest rate at all, probably the USD would strengthen quite a bit. But we have no data on that. If it was below forecast, again, we don't have much data on that, but probably the USD would weaken if they lowered it 0.5% instead of 0.25%. If it comes in matching the forecast, again, it's like 50-50. 3 down, 4 up. It's as close to 50-50 as you can get with 7 data points. We do see that the upward movements were a bit stronger than the downward movements. So if it comes in matching the forecast, there's more of a push for the USD to weaken and the euro to go up rather than vice versa. Okay, so you do have that trend a bit. So if you can catch a nice low point with the interest rate being lowered 0.25% as expected, the trend is probably the USD will give ground to the euro if they indeed cut the rate by 0.25%. Okay, with an average range movement pretty big, about 63, 64 pips over 4 hours time. And you can do smaller time periods over 1 hour. Again, more upward movement than down in terms of size of movement. And in the first hour, it actually percentage-wise is better. So I might be looking to get out of my trade after the first hour with over 50 pip average range movement and 71% certainty from the past that that's the direction it'll go. Whereas if I wait 4 hours to get out of my trade, one of them reversed and went back down the other way. And I'm closer to 50-50 in the end. Okay, so you could start to look at length of time that you'll hold the trade, not just direction that you would trade. And I like this look here with the 1 hour look. So if I can get in the first 5 minutes with one of these dips down or with an upward movement that you see some of these only moved in the first 5 minutes, 20 pips. If I expect after 1 hour, it's going to go 52 pips on average, then maybe that's a good entry point I'd like once I see the numbers come in maybe as expected with this announcement. Okay, so you can start to find statistical advantages for different time frames in the direction that it shows in the past it's gone the most, and not only have an idea of what direction you want to trade after you see the announcements, but also what time frame you'd want to hold those trades before you get out. Okay, this is called data-driven trading. And you know, some economies, some announcements, you might find that you don't usually trade on, like let's say Canadian. I find sometimes a lot of the smoke is cleared from other announcements earlier in the day, and you find a good deal of predictability with some announcements even in smaller economy countries. So if we look at the Canadian announcements, and this is something I've found many times, this is an announcement for employment change. If this comes in above forecast, okay, look at that. 67% of the time, that's 2/3 of the time, the Canadian strengthens against the USD. If you put a short stop loss here to avoid a large loss on the one that went the other way, only one really went the wrong way significantly. This one barely moved, and all of the others went down with an average range movement of 43 pips in the first hour. Okay, 67% of the time down. And it makes sense. If this is above forecast, meaning more employment gain than expected, the Canadian strengthens and pulls the USD down 2/3 of the time in the hour following the announcement. What about after 4 hours? Okay, still 67% of the time with an average range movement of 53 pips. And one of these went much further, okay, than the others. But 4 of them went in that direction. Okay, so what if it comes in below forecast? Look how pronounced the opposite effect is, and even stronger. So now we're talking 80% of the time, the Canadian dollar weakens if the employment change is below forecast. So if this number comes in worse than expected, below forecast, after 4 hours, you can expect, based on the past numbers, 80% of the time, you'd win in the buy situation here going against the Canadian dollar. Only once did it go the wrong way, and look how small it went. It went a very short distance compared to the average climb of the 4 that went up. Okay, So not only is it 80%, it went up when these came in worse than expected, it also went up further on average individually than the one that went down. So you probably have 95% of the movement up, or 90% of the movement pip-wise up, and it went directionally up 80% of the time. Okay, 81 pip average range movement. That's pretty big. Okay, we're talking the longest moving one was 85 pips, 87 pips, something like that, and another one that was 76, near 80 pips. So this is an interesting one to look at, and I might be more inclined to go with the buy situation if this came in below forecast because the data looks stronger. But the other situation where this comes in above forecast, also percentage-wise, is there. It's just the size movement. These were pretty small, all three of these. So I feel like the data is stronger, and I would maybe be more selective, and only if this came in below forecast, then I would be looking to buy if I can get a good entry point. And in the first 5 minutes, the range movement, instead of being 81, is only 30 pips. So you should be able to get in those first few minutes before it gets moving, within 10 pips, 15 pips movement, and understand that after 4 hours, the average range movement was over 81 pips on average, okay, with this announcement. So you can really get a trading plan put together for the announcements that you think you'll be able to pay attention to as the numbers are coming in, and already know what direction you'll trade, how many pip movement you're looking for, how long would you keep the trade running before you'd look to get out, etc. Have a whole trading plan based on how these numbers come in for announcements that you think show the strongest statistics. Okay, that's one style of trading with the fundamental news, and it's very specific. It doesn't involve guesswork, really. It's based on numbers and past statistics. Now, excuse me, when we're trading on news, sometimes it's more up to how you interpret the situation. It's more of an art than a science when we're talking about who won the election and what effect it will have and how strong of an effect. Many were thinking that Tesla would have reason as a green energy company, right? If you call battery-powered cars green energy, some would say they're not so green because of all the chemicals in the batteries. And what do you do with those batteries when they go bad? And all the chemicals and harmful substances inside the batteries, where do you store all these old batteries? So maybe not so good for the environment down the road, but zero emissions anyways while you're driving them. And many thought that green energy companies, as Tesla is very much considered by many, would do poorly with a Donald Trump win. Tesla actually went up dramatically after the election, and some attribute that to the fact that Elon Musk is expected to take part as part of the administration with Donald Trump. And so maybe that was some of the momentum for Tesla. In general, the whole market had positive momentum because of the expectation of tax cuts and deregulation moving forward. But it was interesting to see Tesla have such a pronounced move when the candidate that's not so strong for green energy as a preference and leans towards really opening up and deregulating the fossil fuel side of things. Not that Trump is against green energy, he is for it. He's just also for a balanced approach with the drilling and the fracking being opened up more along with it. But let's take a look then at some specific instruments, maybe in the market buzz, and see what we can find in terms of trend analysis that's expected, and maybe some articles that have come in. If you haven't used the market buzz, it's another nice tool along with the economic calendar for fundamental news. So if we bring up the market buzz, we can look up any instrument class and any instrument within it that we offer. Even cryptocurrencies are here, commodities, indices. We'll leave it on stocks for now. And if we look at Tesla, we can see the trend analysis. If there is one, yes, there is one today. Price may rise over 23%. Again, interesting, being more of a green energy company, and more of a fossil fuel guy winning the election. But this is the situation, expectation, large rise for Tesla stock. Tesla articles are found over here, articles that mention Tesla, and you can read through any number of these articles to see if you can pull any information that can help you decide whether you trust this trend analysis or not. So the articles can be found just by clicking on them. And if I wanted to read this article, there's a synopsis, a little summary of it, and I can also get the whole article by clicking on Story Continues. So very easy to find the latest fundamental news. And then if you, let's say you find news that makes you feel bullish or bearish about the particular, in this case, stock, then you can check the trend analysis and see if that agrees with your directionality. And if you were from the news feeling that, hey, Tesla should go up, and then you look at the trend analysis and you see, hey, there's a signal here showing an expected uptrend to a price like 290 to 308, then maybe you're interested in that stock, and you can put your spots where you think you'd take profit, where you'd have your stop loss. Here it's showing a pivot line down here on 223. So if it was to drop below there, they're saying here that then you'd look for further downside. So if you find an article here that on any instrument that makes you think that, hey, I might want to buy or sell on this, and it agrees with the trend analysis maybe, then you go and you pull up that particular instrument and look at the chart yourself. So, you know, given the fact we already know some fundamental news that happened with the election, let's take a look with the expected rate cut coming as well. If I want to buy or sell on Tesla, let's bring up the chart first. And see what the chart looks like. If I can load the chart, let's try it again. Try it from here. I'm not quite sure why the chart doesn't want to load. Apologies. Let me see if any of these will load. Maybe I'm having some connectivity issues on my side. Let's try something more simple. Gold. I'll refresh my screen. Let's see if this fixes it. If I can't get my charts to work, we may have a shortened session today. Okay, I refreshed the screen and there we are. Now we have gold. Let's see if Tesla will come up now. I think it was just connectivity on my side. Yeah, there we are. Okay, so when all else fails, refresh your screen. Okay, so sometimes it's the Wi-Fi where I'm running my sessions from. So if we look at Tesla, we see the climb yesterday. This is a one-day candle. I mean, just straight up like a rocket, and that's with the election results. Here's the election results coming in on Tuesday. And then once it was known Trump won, up it went like a rocket. Expectation, according to the signal, was to get up to what point? Let's click on the signal again. There's no active signal showing here. There's a symbol here when there's a live signal, but there was that trend analysis showing that Tesla was expected to rise. So we'll go to the market buzz because I don't remember the exact price. that signal said the rise was expected to go to. So let's go back and pull up Tesla and look at the trend analysis. Okay, and the upper end of that was 308, 290 to 308. Okay, so let's remember that number. And we'll bring Tesla back up. 290 to 308. And so we almost got to 290 yesterday. Let's go to 1 hour candles. You see the gap up? And so we'll draw lines here. 290 is right here. It just reached the first take profit recommendation almost and stopped. And then if we draw another line, 308, that is about there. Okay, so here's the take profit zone from the trend analysis of where they're saying this is expected to move up to. So according to the market buzz, this isn't done climbing. Okay, and this is a sign of huge positive sentiment. So it very well could get it into this zone or near the top of it. Let's go to larger candles now to see if we can find why is that the price level. And so what we see is if we follow the upper part of this take profit zone over, there's resistance here on the candles. On the 1 week candles, we see once, twice, 3 times, 4 times, 5 times, 6 times. It tried to break this price area and each time got shot down once, twice, 3 times, and down it went. So this is why this area is the upper end of that take profit recommendation, that they think there can be upward momentum, but it might have trouble breaking past the top of this zone, which is capped with this area here of resistance on the 1 week candles. So it makes sense, 308. If so, right now, what could you do? If you're not in on the trade already, then you might be looking at a pending order that if it breaks the top, this first level, this is acting as resistance now from yesterday. If it gets above that price, you might have a pending order to buy. So you might say if this move goes above this resistance level from yesterday, then buy, and your take profit would be up here just below that resistance, up around 307. Okay, so a buy-in at like 293, something like that, if it breaks the resistance, and a take profit just before that 308 resistance from the 1 week candles, which may be around 307, 306. Okay, but making it confirm an uptrend still before jumping in. So that's a technical setup for the fundamental news that might be pushing something like Tesla up. Okay. And that trend analysis so far has been right about upward movement. It just hasn't reached all the way to the take profit zone all the way. Something that could throw that type of movement off, obviously, escalation of war in the Middle East. You certainly could see a pullback of all of the equities, or pretty much a lot of them. And so, and the safe havens could strengthen with that type of effect. So have your risk controlled on the downside with your stop loss or a hedge position set down below to sell, something that will manage risk. But you still, with the current momentum, could go after that trend analysis, which is showing expected rise. Okay. And we understand that tax cuts and deregulation can help pretty much any sector of the stock market. If we're talking about corporate tax rate and business tax rates expected to be cut moving forward with the Trump administration, that's pretty much bullish for most sectors of stocks and markets in general. All right, so what about something like crude oil? This is an iffy one, right? Because there's been a shown decrease in the quality of the jobs reports out of the U.S. They're lowering interest rates because the economy has slowed down so much, and all of that leads to less demand for energy. So there's reason for crude oil to drop. And we do see that was after an initial spike, we see now dropping of crude oil. This was the spike with the election, hit this resistance, but now down so far today. Okay, so it looks like a healthy resistance level on crude oil up here. Resistance, resistance, drop, back up, resistance, resistance, and drop, mirroring this resistance and drop. Now here we go, resistance and dropping. The fundamental news is kind of on the side of crude oil to drop unless there's escalation in the Middle East, right? That fundamental situation could be an impetus for crude oil to spike back up to a high up like this up here or even higher. Okay, so if I'm selling right now on the negative economic sentiment from the poor jobs out of the US, expected numbers coming out today with initial jobless claims, if those are higher than expected, that also could create economic fear, and you could see something like crude oil continue to drop today if that happens. So from a fundamental standpoint, it makes sense to me. Stop loss up here, go with this downtrend, and have your take profit somewhere near a low where there's a support level like right here where it hit and bounced, or if you're more patient, with a bigger support level like down here where it hit once and went up, hit twice and went up, hit 3 times and went up. So if this is dropping, likely it'll have trouble breaking below this support level, at least temporarily anyways. So if this is my setup with my take profit down here, going with the slowing economy and less demand for crude oil, I would have take profit maybe before this support level, and I would have stop loss above this resistance. If it breaks above there, then maybe something happened in the Middle East to reverse this trend. So about a third of the risk to make 2 to 3 times the profit, okay, going in the direction of the current trend. So this could be something that you'd make that might make sense for you. So if I click on sell as the option, take profit, I can program, and you see the risk management here. If my take profit is at 66.8 and my stop loss is down here, and I put it up at 72.9 to get above that resistance level. Okay, I'm going after about double the potential profit compared to the risk. Okay, 28,000 potential profit, 14,700 risk. So now I can go and adjust my trade size to be the amount of risk with that setup, the amount of risk that I want. So if I do half a lot, I'm risking about 1,000 to make 2,000. If I do a third of a lot, I'm risking about 1% of my balance to make 1,200 or so. So you can get the amount of risk that you want and an amount of potential profit. Now I'm down below 1% of my balance. You could trade a different percent of your balance, but have a set amount that you're willing to risk during your trades, and then adjust the trade size. Once you get your exit points and entrance points set up, now I can adjust the trade size for this distance to my stop loss to get the amount of risk that I want. So now I'm down below 1% risk, going near 2% profit, and I'm ready to make my move on that. Okay, so very easy to risk manage your trade. In this case, I'm trading in the direction that I think the fundamental news is pushing crude oil. In the bigger picture, not so much the election news, but the bigger picture that economies are really slowing down. We saw some negative numbers today on the economic calendar out of the European Union as well, out of Germany, worse than expected data. And that just piles on top of the horrible jobs report out of the US last week. So all of that points towards less demand maybe for energy moving forward. So it makes sense to trust maybe this resistance level. And also from a technical standpoint, it's an opportunistic entry point to get your stop loss above this resistance and still only risk half of what your potential profit is to take profit without even having to break the support level down here. Okay, so trying to combine the fundamental news and that momentum to trade in a direction, but then finding with the technical analysis entry points and exit points that are opportunistic. And then you have kind of the best of both worlds. Any questions, comments before we end things? I do see that there's already a question, so let me take a look. Okay, the question is, how would you trade metals like gold, maybe an index like the US 30, taking into account the Fed's announcement on interest rates later today? And so we talked a bit about that already. My take on that is usually the rate cuts or rate decisions, increases and decreases, or when they keep it the same, usually the expectation that's listed is how it comes in. And so if that's the case today, if it's expected, which the expectation is 0.25% rate cut in the US, if that's how it comes in, then I don't see any panicked reaction on the market from that. And we saw that in the statistics when we looked at the economic calendar for the rate decisions, both out of the UK and the US. When rates decisions come in as expected, you almost have 50-50 movement up and down. It's not some huge reaction. The bigger reaction, what I find with the rate decisions, is the press conference afterwards. There will be a statement after the rate decision that then when they start talking, that's where we tend to get the bigger movements. But because it's not a number that's being announced, it's a conversation that's being had, the predictability on what they will say is not easy, and it happens in the moment. So if you're able to watch the conversation after the rate decision, you very well may see that they start talking more bullish or more bearish about the markets. They might start leaning one way about future rate decisions. You know, maybe they do a rate cut now, but then they say we really need to be careful about future rate cuts because inflation hasn't come down where we want it. Then you could see a rapid reaction in one way. Or if they speak differently and say definitely we're going to have strong rate cuts moving forward as well, then you'd have the opposite reaction, because you know those conversations that are had after the rate cut, that press conference, that's where you get information that nobody knows yet. The actual rate decision is already cooked in, because usually it comes in how it's been expected all along. So those movements have occurred, but when they start talking, that's typically when you get the bigger movements. It's a bit harder to trade on though, because it's not a flat number. You have to listen to what they're saying and understand whether they're starting to talk strong about future cuts, or are they talking weak about future cuts. And then you'll get a big reaction one way or the other, potentially, compared to the rate decision reaction. Very good question. And that response wouldn't just be on the stocks, but also on gold and everything else. Kind of a muted response until you listen to the press conference. Okay, there's a question about how much can I risk per trade if I have 500 on the account. If you have 500 in the account, you can risk pretty much all of it on a trade, okay? But I wouldn't advise that you do that, but you could if you wanted to. The important thing is whichever decision you make in terms of how much you want to risk, whether it's 1% of your account, which would be $5 per trade if you have 500, or something bigger or something smaller, once you decide how much you're comfortable risking per trade, then the order window, as I showed you, as we set up some trade examples just now, the order window then helps you calculate what trade size you need once you set up your stop loss. Then you can adjust the trade size and see how much am I risking on this trade. So I can't advise you how much you should risk, but whatever amount you decide on, then the order window, as I demonstrated, will help make sure you take the right trade size for the amount of risk that you're comfortable with. Okay. All right. Good questions, guys. Thank you for attending. And my next session is next week on Wednesday. That's my later session where I do the technical analysis webinar. And that's a bit later into the evening, my time. And so UK time, it's 5 p.m. UK time that I'm doing that session on Wednesdays. All right, everybody, thank you for joining. Good luck with your trading the rest of the week. I think we'll have some nice movements. All right, take care. Bye for now.